Hello, and welcome to our channel where we explore the intriguing world of transfer pricing and the arm's length principle. In today's episode, we'll delve into the fundamental concepts of transfer pricing and the arm's length principle and why they are crucial in the realm of international taxation and business operations. So, what exactly is transfer pricing? If you ask me, I will give you a very simple definition. I would say that it means setting of prices of goods and services sold between different entities within the same corporate multinational group. Now, you might be wondering, but how does setting up of the transfer pricing matter? This is the main question that we are going to discuss today, along with what is an arm's length principle. So, transfer pricing it plays a very crucial role in determining how the profits are allocated among different subsidiaries or divisions of a multinational corporations. So, if you see the slide, there are different countries across the world which have different corporate tax rates. So, say India has a tax rate of 25%. Say UAE has a corporate tax rate of 9%. Now, there is a difference of around 16% of tax rate between UAE and India. So if there are two entities which are operating between these two countries, two group companies are operating, then for them to pay higher taxes in UAE, to allocate higher profits in UAE will make more tax sense because they will end up paying lower taxes in UAE, and if they allocate higher profits in India, they will have to pay tax at 25%. So the differential corporate tax rates around the world, it gives an opportunity of tax arbitrage to the multinational enterprises, and it helps them to reduce their effective tax rate of the group as a whole by shifting their profits from a high tax jurisdiction to a low tax jurisdiction and essentially paying lower taxes as a group. Now, this slide, it has given an example of it. I have taken India and Singapore. I have taken different numbers here, and just to give you an idea that suppose in India, in the first scenario, the profit allocated to India is nil. The profit allocated to Singapore is 5,000. The tax in Singapore is at 850, which is 17%. So these numbers are random numbers. They are just for representation purposes here. Now, suppose in the second example, the profit in India is 1,000 and the Singapore profit is 4,000. The tax in Singapore is at 17%, it is 680. The tax in India at 26% is 260. So similarly, I have done this 5,000 profit split between India and Singapore in all these lines, across these lines, and try to calculate the total group tax percentage in the last column. And if you will notice that higher the profit in India, the effective tax rate is the highest because the tax rate in India is 26% and the tax rate in Singapore is 17%, is what we have assumed in our example. So therefore, the group, which option do you think the multinational group would use if they want to reduce their total group effective tax rate? 17%, right? So this will be the most tax efficient structure for the group. However, to avoid this kind of a tax practice, or to avoid this type of a tax arbitrage or evasion or shifting of profit from one country to another country, the OECD, the UN countries, all the countries across the world, they have adopted transfer pricing regulations within their corporate tax regime to keep a check on such practices. Now, how do they keep a check is the next question. Let us move to the next slide. Now, coming to the arm's length principle. So, by way of following or adopting the arm's length principle, a check is kept on profit shifting or base erosion practices. So, Article 9 of the OECD Model Tax Convention defines the arm's length principle and what associated enterprises are. It says where an enterprise of a contracting state participates directly or indirectly in the management, control, or capital of an enterprise of the other contracting state, or the same persons participate directly or indirectly in the management, control, or capital of an enterprise of a contracting state and an enterprise of the other contracting state. And in either case, conditions are made or imposed between the two enterprises in their commercial, financial relations, which differ from those which would have been made between independent enterprises. Then any profits which would, but for those conditions, have accrued to one of the enterprises, but by reason of those conditions have not so accrued, may be included in the profits of that enterprise and taxed accordingly. So Article 9(1) is the genesis or the basis of the transfer pricing or the arm's length principle across the world. Now, the transfer pricing regime, which is incorporated in our Income Tax Act in India or the corporate tax law of different countries across the world, is based on this fundamental article. What it says is, it is first of all defining what an associated enterprise is, means what are the related parties within a group, and the transactions between these related parties are covered by the transfer pricing regime. Then it is saying that whatever transactions are there between these associated enterprises, they need to be undertaken at the price or at conditions which independent enterprises would be dealing in. So suppose an independent party is selling a kg of a particular good at 100 rupees a kg, the associated enterprises also need to sell it at 100 rupees a kg. Only then it will be considered at an arm's length price. Otherwise, what it is saying is that there is a possibility of making adjustments. Adjustments will be made to the taxable profits of the enterprise and it will be taxed according to the arm's length principle. So this is all about the arm's length principle. So essentially, the arm's length principle, it says that the transfer prices set between related entities should be similar to those that would be negotiated between unrelated parties or independent enterprises in a similar transaction. Now, the transfer pricing laws or the regime of different countries, they include within their corporate tax provisions certain provisions for transfer pricing as well. They have their own code for transfer pricing in each country, which defines what an associated enterprise is, what is an arm's length principle, what kind of transactions, international transactions, are included within the scope of transfer pricing regime? What are the methods to compute the arm's length price? Then what kind of adjustments can be undertaken by the tax authorities, etc. So all these guidelines are further provided within the corporate tax law of each country. So the basic fundamental points for an arm's length principle which need to be taken note of are: there has to be two or more entities which are related party or associated enterprises. The conditions between them are not as per what an independent enterprise has. So the conditions between them have to be as per an independent enterprise for them to be at an arm's length. And in case their conditions between them are not as per the independent enterprise, then there will be certain adjustments to profits. Now that's all for today. In our next session, I will discuss what are the alternatives to arm's length principle. Thank you so much. Do subscribe and like our channel for more regular updates on transfer pricing. Bye-bye.